Strictly speaking, we have to eliminate this kind of intra-group transaction every year because neither the parent nor the subsidiary will input this consolidated journal entry in their own financial statements. So the parent's own financial statements regard this interest income as correct. So that's why parent will not eliminate the interest income. The same for the subsidiary. The subsidiary will regard this interest expense as correct. So therefore, the subsidiary will not eliminate this interest expense in its own financial statement. It's only on consolidation that we will eliminate this interest income and interest expense. So that's why this debit to the interest income and credit to the interest expense is only a consolidation adjustment. Every year, I receive a new financial statement from the parent and a new financial statement from the subsidiary. Neither the parent nor the subsidiary has put through this debit interest income and credit interest expense in their own financial statement. So therefore, every year, as a consolidation accountant, after I receive a new financial statement from the parent and a new financial statement from the subsidiary, I need to repeat all the consolidation adjustments that I have made. So strictly speaking, I should repeat this debit interest income and credit interest expense on consolidation. But I'm not that stupid. If this is last year's interest income, it has been costed to retained earnings. If this is last year's interest expense, it has been costed to retained earnings at the end of last year. Therefore, basically, if I have to repeat this journal entry, I will need to debit retained earnings and credit retained earnings. I don't need to debit retained earnings and credit retained earnings. So therefore, strictly speaking, we think that only those consolidation journal entry that have a one-side effect on the group retained earnings need to be reenacted. We only need to repeat those consolidation journal entry that has got a one-side effect on the retained earnings. If it is only debit retained earnings and credit retained earnings, the effect on retained earnings is zero. I don't need to repeat. We need to repeat those consolidation journal entry which has got a one-side effect on retained earnings so that we can reconcile the current opening retained earnings on consolidation with last year's consolidated closing retained earnings. Let's see the impact. So we'll illustrate this impact by using two assets. The first one is inventory and the second one is property, plant and equipment. Inventory first. Take this as an example. A owns 100% of B, and on 1st of March 2007, A purchased inventory at a cost of 7,000. 1 month after, A sold it to B at a price of 10,000. Assume a tax rate of 30%. A is the parent, B is the subsidiary. So therefore, when A purchased the inventory, of course A recognized the purchase, 7,000. And then when A sell it to B in A's own financial statement, A will recognize a sales of 10,000. Because A only purchased it at 7,000, therefore in A's own financial statements, A will recognize a 3,000 profit. B has purchased it from A, so therefore in B's own financial statements, they think that they have got an inventory of 10,000. It's 100% correct in their own financial statement, but on consolidation, A and B, because they are parent and subsidiary, and on consolidation, any parent and subsidiary within the group is only just like a department. So any intra-group transaction within the group should not be reported as sales. So therefore, this 10,000 sales should not be regarded as a sales because we did not sell it to outside party. Only transaction with outside party should be recorded as a valid transaction. So therefore, on consolidation, I need to debit away this sales. So I debit sales. From the viewpoint of A, this is a sales. From the viewpoint of B, this is a purchase. So therefore, we have to credit purchase as well. So we credit purchase. So ultimately, because cost of sales equals to opening inventory plus purchase minus closing inventory, if we credit purchase, strictly speaking, we are crediting cost of goods sold. So we debit sales and we credit cost of goods sold. This is not enough because this inventory still remains in the group. Originally, the inventory should be stated at 7,000. Now you have stated it at 10,000. So therefore, there's an overstatement of the inventory. It should be 7,000. Therefore, on consolidation, we should credit inventory. So we credit inventory 3,000. Whenever you credit inventory, you need to debit cost of goods sold because cost of goods sold is opening inventory plus purchase minus closing inventory. Now you are crediting the closing inventory. Therefore, if the closing inventory is smaller, cost of goods sold should be bigger. So therefore, you should credit inventory and debit cost of goods sold. Very often, we may combine these two journal entries into one. If we combine these two journal entries into one, basically you are debiting sales, crediting inventory, and crediting cost of goods sold. So therefore, we debit sales, so sales will become 0. There's no sales to outside party. Cost of goods sold, because there's no sales, there should not be any cost of goods sold. So therefore, when you credit cost of goods sold 7,000, exactly you offset this 7,000 that A has recorded. There's no sales, there's no cost of sales. In addition, when we credit inventory, the inventory figure has been reinstated to 7,000. So this is the situation on consolidation. Everything has been restated as if there's no intragroup transaction at all. One further problem, we understand that A's record is correct in its own financial statements. B's record is also correct in its own financial statements. So basically, tax is charged on an individual company basis. So when a company claims that they have got a sales with a profit, taxation should be charged on this profit. However, on consolidation, you said that we have to eliminate this unrealized profit. So therefore, there's a temporary difference. And therefore, there will be a deferred tax implication. Because you credit inventory, so the inventory figure go down. So in the future, you will earn less tax, you will earn less profit, and therefore you will pay less tax. Therefore, there will be a deferred tax asset. So because you credit inventory, we debit deferred tax asset. Because you debit, as a result, you debit 3,000 profit. Profit is lower, and therefore you credit tax expense. Why? This is the deferred tax implication. How about if we hold the inventory more than one period? So in the year of sales, this is what we have done. I have just copied this 3 journal entry from the previous slide. So this is what we have done in the period of sales. 1, 2, 3. So we eliminate the intragroup sales, we eliminate the unrealized profit in the closing inventory, and we account for the deferred tax. Now, assuming that this is 1 year after. 1 year after, in the following year, next period, if this inventory remain unsold. So, strictly speaking, this is 1 year after. So I collect the new financial statement from the parent and the new financial statement from the subsidiary. Neither the parent nor the subsidiary has input this journal entry. So therefore, as a consolidation accountant, I have to repeat this journal entry. But as I've said before, I'm not that stupid. Last year it was a sales, so therefore this year is a retained earnings. Last year it was a cost of goods sold, so this year is a retained earnings. I don't need to debit retained earnings and credit retained earnings, so therefore I don't repeat this journal entry because the net effect on retained earnings is only 0. It's only debiting retained earnings and crediting retained earnings. But for the journal number 2, the net effect on retained earnings is 3,000. Last year it was a cost of goods sold, this year it is retained earnings. So therefore we debit retained earnings to repeat this journal entry. Last year it was a inventory, still we credit inventory. Still we need to credit inventory because this inventory remain unsold. So that's why in your closing inventory, still we have to reduce it by 3,000. So we repeat also the deferred tax implication. So we debit deferred tax asset, and last year it was a tax expense. So this year we credit retained earnings. This is the journal entry to repeat what I have done last year as a consolidation accountant. Now, what happened if there is a sales of the inventory at the end of this year? Before the end of this year we have sold this inventory. So again, I don't need to repeat this journal entry, the first one, because I don't need to debit retained earnings and credit retained earnings. For the second one, I will repeat this journal entry. I will debit retained earnings and credit inventory if I simply repeat this journal entry. As I've said before, because we have already sold this inventory, this credit to the inventory is no longer required because we have already sold this inventory. That means in our closing stock, in our closing inventory, this inventory has been sold already, so we don't need to credit inventory for this 3,000. Therefore, actually, I have to debit away this credit. So the effect on inventory should be 0 because it has already been sold. Whenever we debit inventory, we need to credit cost of goods sold. Because cost of goods sold is opening inventory plus purchase minus closing inventory. So if the closing inventory is higher, debiting inventory means inventory is higher. Closing inventory is higher, means the cost of goods sold should be lower. So therefore, whenever we debit inventory, we credit cost of goods sold. Very often, I will combine these two journal entries into one. So if I combine these two journal entries into one, this means we debit retained earnings and credit cost of goods sold. Right? So we debit retained earnings and credit cost of goods sold when we combine these two journal entries. How to interpret this journal entry? Debiting retained earnings. Debiting retained earnings means last year's profit should go down. Crediting cost of goods sold means the profit for the current year should go up. Crediting cost of goods sold means profit is increasing. Right? We think that last year's retained earnings should go down because it is an unrealized profit last year, and this inventory has been sold in the current year, that the profit has been realized in the current year. When we see from this, right, no matter how much the company B has sold this inventory, say for example, if B actually sold this inventory for 12,000, because B think that the cost of goods sold was 10,000, so that's why B only recognized a profit of 2,000. But for the consolidated group's viewpoint, actually the original cost was 7,000. 7,000 is the amount that A have purchased this inventory from outside party. So therefore, all this profit should be realized when we sell it to outside party. So therefore, the cost of goods sold should be only 7,000. This is the reason why we credit cost of goods sold 3,000 here. So this is 7,000. So we realize all the 5,000 now. And also, we have successfully sold all the inventory. One further complication, again, as we have said before, this elimination journal entry, this consolidation adjustment will affect the deferred tax implication. Deferred tax. Because you debit retained earnings for deferred tax implication,